So our last lecture, we went over inventory accounting. And so inventory accounting had a lot of nuances to it, right? We had two sides. We had the revenue side for inventory and merchandise accounting and the cost of goods sold side. And so for every time we sell inventory, we have to worry about capitalizing the cost first when we purchase it and then selling it. And we recognize the expense, and we also recognize the revenue related to the expense. We also talked about a multi-step income statement versus single step, how we have to calculate gross margin before net income. And so now we're going to talk about in more detail how to determine the cost of the inventory. And so previously we talked a little bit about the shipping costs that go into inventory, but now we're going to determine how do we ultimately recognize those costs that we've determined and match them to the revenue. And the reason this gets complex is because our inventory costs change over time. If you go to the grocery store and you're buying eggs, one day it could be $2, the next day it could be $3, the next day it could be $5, and then the month after it might be $1, right? Same thing for any company that sells inventory, that the price changes. And so how do we know if we need to recognize the expense of $1 or $5 or $10? We have to determine an accounting assumption on how we're going to match the expenses. And so we're going to go over that today. So let's first talk about what makes up inventory items. So merchandise inventory includes all the goods that a company owns available for sale. So anything that we might sell to our end users. And so there was a lot of questions last week about, especially after class, about why is this a supply versus inventory? So supplies are products that we hold for personal use, for a company's personal use. So something that might be a supply to my business could be an inventory for another business, right? Like a grocery store might sell toilet paper. It could sell toilet paper, and that could be inventory for them. But an accounting firm might have toilet paper too for their employees, but they're not selling it. I hope they're not selling it. It's a supply for their employees. Same thing, right? An office supply store might sell printers, but then for an accounting firm or a consulting firm, that printer is more of a supply, or it could even be an asset. And so it really depends what kind of business we're operating. And that's going to be the fascinating part of accounting when you get into it, is learning about each one of these businesses. Every day I get to learn about a new product or a new transaction that's never occurred before because I'm in this field. So that's where it gets exciting. But you have to always ask yourself, where are we and what business are we assessing? And so if it's available for sale, it's inventory. But we need to consider other complexities. So what if a good is in transit? Would we consider it inventory? Well, we learned about this a little bit in the last class. So what did we talk about last class where inventory the timing of when we recognize inventory might change or costs might change? Like, remember what we have to include freight for some of our inventory costs? What is that called? I'll let you talk and mention in the chat. Just type it in. Okay, so people are putting some great answers here. FOB, yep. FOB, shipping point or destination. So freight on board. That's not only when we determine how we're accruing for the costs, it also determines when legal title will transfer. And so if I'm FOB shipping point, I own the product, I own my inventory when it ships. If it's destination, I don't own the inventory until I receive it. And so if it's in transit, it depends on the shipping point, or if it's shipping point or destination. It's on consignment. Does anyone know what consignment means?
It's like when you don't own the product, but you're selling it for someone else.
What was that?
It's when you don't own the product, but you're selling it for someone else. So
Yeah,
you keep like a share of it.
That's a great way to think of it. So some car dealerships do this, where they're selling it for the car dealer. They're selling it for the car manufacturer. They'll hold on to the cars. They don't pay for them. They just hold on to the cars, and when they sell it, they keep a portion. So some car dealerships do this. Or if you go to other countries, it's very common to do this in like night markets or in specific markets where you'll bring your inventory over to a shop and they'll hold that inventory for you, but not pay you until it sells. And so that means consignment. It means that the original owner still holds the legal title, and then the shopkeep doesn't have the legal title. They're just holding the inventory for sale. So if I'm holding a consignment good, it's not actually my inventory because it's someone else still owns the legal title. Or if a good is damaged or obsolete, we can't recognize it as inventory anymore. So we have to do assessments for it. So here's examples. We went over it in detail. FOB shipping point, ownership passes, or title, we call that title is being transferred, legal title for shipping point once it's shipped, because it's shipping point, shipped. Or if it's destination, the title transfers to the buyer when it gets to the destination. Consignment, we talked about this, right? Merchandise is included in the inventory on the consignor, the owner of the inventory, not the consignee. So consignor is the original owner of the inventory. The consignee is the one holding the inventory for sale. The consignee never considers it as inventory. And so this becomes interesting when we're thinking about transactions, right? So what is the obligation from each party? Like, as a consignee, my obligation is to arrange for a good to be sold. It is no longer for me to own a good and sell it, but I arrange for the good to be sold. So there's these key distinctions you're going to be learning about. And if it's damaged or obsolete, we cannot recognize value because it cannot be sold. And so cost should always be reduced to something called the net realizable value. So if we have something on our books, let's say I have $1 million of inventory on my books, but what if I'm selling a bunch of flip phones that can't be sold? That would fraudulently misrepresent to my investors what my products are worth, right? If I'm holding on to a bunch of, what else is like a DVD players, no one's going to buy DVD players. So they're considered obsolete. So I can't have inventory. So there's a complex way to get to this number, but what you need to know is that we can only have inventory at the net realizable value. Now, what does this change? This kind of violates one of the principles we talked about. What principle did we talk about that this changes? We had a few accounting principles we talked about at the beginning, right? We had monetary unit assumptions. We've had historical cost principle. We've had revenue recognition principle. What is this tied to?
Is it historical cost, right?
Yeah, historical cost. Yeah. So this is different than historical cost, and it's because we will never recognize the expense, right? We're not going to be able to tie it to a revenue being recognized, so it'd be inappropriate for us to account it on our books anymore. Good identification. So see how these all tie in. So how do we identify the costs of the merchandise inventory? Well, we have to include everything that is brought or required to bring an item to a sellable condition. So we talked about this briefly, but we're going to go into more detail in this lecture. So when I'm purchasing, let's say I purchase a piece of equipment for my factory that makes shoes. That equipment might cost $1 million. But maybe before I can bring the equipment to be maybe when it's sitting in my factory, I need someone to install it before I can use it. And maybe I need insurance on the equipment. And maybe I need it to be shipped. And then there might be discounts and allowances. And maybe I need someone to advise me on how to use it before I can use it. And so the question is, which one of these will ultimately be considered part of the inventory or the equipment? Let's say if that big piece of equipment is something I'll be selling, or which one of these would they be a manufacturing cost or would they be a training cost? And ultimately it's what if we wouldn't be able to sell that piece of equipment or that piece of inventory until we've received that kind of service, it would be included in this cost of the inventory. And so what we need to be doing is making sure, like, if there's storage, like if I need to store a good for a month or two before I sell it, that needs not to be expensed as a warehouse cost. It needs to be added to the cost of our inventory so our gross margins can be calculated correctly. And so one of the ways that we make sure that we're calculating all these costs and associating them is doing a physical count of inventory. And I mentioned this briefly in the last lecture as well, but I'm going to go into a little more detail here of, as an auditor, my first year of work, I had to do 10 different inventory counts for a variety of industries. So every kind of industry that holds inventory has to do something called a physical count. And so their employees at the end of every month or end of every quarter or year, they'll go and count all of the goods to see if they're there. So, and to see if they're valued correctly. So I did it for companies like some companies similar to Target, all the way to companies as complex as like medical device companies or steel beams. So you'd go and you'd see in the computer, you'd see in the system, hey, this company has 100 tons of steel. And then we go walk onto the warehouse floor and it's in lot 1A, it'd be pre-numbered. It's in lot 1A, item 1001. And then you'd go there and someone would take a forklift, pick up all the steel bars, put them on a weight machine, and you'd calculate, okay, do we actually have 100 tons of item 1001 in lot 1A? And so you go and compare and make sure that everything in the system is correct. Now, when you have multi-billion-dollar companies, this is rather complex, right? And so as auditors, you take samples and it can be pretty interesting to learn about these different businesses. And so the goal there is to confirm, hey, does this inventory actually exist? Do the company still have it? Is it obsolete? Do we have the right amount? Do we have the right weight? And then generally we'll have people take second counts, auditors take counts after those counts are done, and managers will confirm that those counts were done correctly. The reason being is because there's a lot of risk around inventory. People could steal it, it could go obsolete. So we have to do a lot of physical controls around it. So need to know. Let's go through this problem together. So if we're trying to figure out how much inventory is in storage, I remember when we're doing questions, don't read the fact set first. Read the kind of question first. The question is how many units are in the ending inventory? And so we'll go back and say, at the end of the current period, the carver has 17 units in her garage, 3 of which were damaged and can't be sold. And so we have units in storage or 17, we know that. If we can't sell it, we don't consider it an inventory, we'll go expense it. So that's 3 that are damaged. Plus we know that those goods are in transit, but they're on FOB, plus units in transit that are FOB destination, and another 11 units on consignment at several small retailer stores. So this means so here's where it can get confusing, is it's in transit, but it's FOB destination. So who is it an FOB destination for? Do we mean it's in transit to one of our customers or in transit to us? Here the question is saying in transit to one of our customers. So if we're still in transit to one of our customers, the title hasn't transferred yet, we still own the title. And so it's still inventory on our books until it gets to them, right? And so we'd include that in our inventory. And then anything on consignment, that means that someone else is holding it on consignment for us. So we still have to have it on our inventory, even though it's not at our physical location. And so this is how we determine the 30, right? So this is where the complexities are, and be careful when you're doing your homework on ask yourself, am I receiving the goods or am I shipping them? And am I holding the goods on a consignment or is someone holding them for me being the business? So let's do the next one. A distributive artistic iron-based fixtures. Well, let's read the question first. What are the necessary costs to get the assets ready for the intended purpose? The iron-based fixtures are $1,000. So we know that we need that. We're gonna have to pay that at least, so we can add that to the costs. It's FOB shipping point. So we have to add in the transportation costs because it's coming to us and the shipping costs are our responsibility. If it was FOB destination, we wouldn't add the costs in, right? Additional costs for obtaining it for sale are $150 in transportation. So we have to incur this. So we would add that, which is the FOB shipping point. 300 of import duties, 100 for insurance, 200 for advertising, $50 for voluntary gratuity, and 75 for enhancing the store lighting, and 250 for the sales staff salaries. So you can see there's a variety of costs, but what is required to bring it to a sellable condition? Well, we need the insurance costs. We need the inventory. Let's see. Yeah, the insurance costs. We need the import duties. These are required. The gratuity, that's not necessary, right? The gratuity just it's voluntary. And so that wouldn't be considered in the inventory cost. The sales isn't required for the inventory costs. It's required to sell it. And the store lighting is is more related to the store. So another selling cost. And so this is where we have to make sure that I'll give you a few questions like these. Make sure you can calculate what's related to the inventory, which compared to what isn't related. Does this make sense? Any questions here? Okay.